Decoding the jargon behind fund management. Unless you know all of the complicated jargon behind fund management, it can be a tricky subject to navigate with confidence. So, let's break down some industry terms. Net asset value. This is a fund's overall value. That means assets minus liabilities. In very busy funds, these values can change with every transaction, so they're often calculated at the end of every day, once the major exchanges close. Expense ratio. Ever wanted to know how much it will actually cost you to invest in a specific fund? That's what the expense ratio is for. It's expressed as a percentage of your investments by dividing the fund's operating expenses by net assets. It's usually stated in your fund's prospectus. Assets under management. These refer to the market value of investments managed on your behalf. It's generally calculated by aggregating the total market value of all assets overseen by a fund manager. In most cases, a higher value is considered a good sign for efficient fund management. Alpha and beta. These are performance metrics used to determine historical performance. They measure investment performance by illustrating if your investment has over or underperformed based on its risk. Alpha indicates your return on investments, ROI, against a benchmark like market value. Beta shows how risky your investment is based on market volatility. Sharpe Ratio. This can help you evaluate investment risk over time. It's a widely used formula calculated with a mathematical formula, but it's essentially two parts. The numerator reflects the time difference between your realized and expected returns from an established benchmark. The denominator is the standard deviation of returns over the same period. Standard deviation. This is another risk measurement. In fact, it's probably the most common way to do that. Standard deviation calculates how much your investment prices differ from the market average. Huge differences means a high standard deviation, or that the investment is risky. A low standard deviation means the investment is relatively safe. Long and short-term strategies. These mean investment strategies that take long positions in stocks expected to appreciate, but short positions in stocks expected to decline. In other words, it's a way of minimizing market exposure. Hedge fund versus mutual funds. Both types of funds are managed portfolios consisting of pooled funds. The difference between the two is that hedge funds usually target high net worth investors and their private investments. Mutual funds, on the other hand, offer investment options for public investors. Market timing refers to moving money in and out of a financial market, or by switching funds between asset classes. All of this is done by making predictions on what the market will do. Derivatives. These are financial contracts between two or more parties. They derive value from an underlying asset or a group of assets or a benchmark. These contracts can be used to trade any assets, either on an exchange or over the counter. There are several different types. Leverage. Borrowing capital as a source of funding to increase ROI is using leverage. It basically means you use debt to make an investment. And there you have it. With these terms, you've got the tools to manage investment funds with ease. Need assistance with fund management accounting? Book a free discovery call with our team.